Hello financial fanatics, and welcome to today's video where we'll be diving into the fascinating world of liquidity. What does liquidity mean and why should you care about it? Are some assets more liquid than others? And how do interest rates impact liquidity? These are just a few of the questions we're going to be tackling in this video. But first, have you ever wondered how quickly you could turn your investments into cold, hard cash without losing value? That's where liquidity comes in, and understanding it is crucial for managing risk and maintaining financial stability. We'll be discussing the two types of liquidity, accounting liquidity and market liquidity, and how to measure them effectively. We'll also explore the impact of interest rates on liquidity and why it's essential to consider liquidity when making investment decisions and managing your own financial health. So buckle up and get ready to learn about the ins and outs of liquidity. But first, let me ask you a question. Can you think of a situation where having liquid assets would actually be crucial to your financial well-being? Share your thoughts in the comments below and let's dive in. First things first, let's break down what liquidity actually is. In a nutshell, liquidity refers to how quickly you can turn an asset into cash without affecting its value. So the faster an asset can be sold for its full value, the more liquid it is. Think of it kind of like this. Cash is the ultimate champion. We've probably heard of phrases like cash is king, while assets like real estate are still mastering the game. But wait, not all assets are created equal. Cash and cash-like assets like money market funds and CDs are considered the most liquid. Some types of securities, such as common stocks and public bonds, are also relatively liquid due to high trading volumes, tighter bid-ask spreads, and fast trade executions. And in case you don't know, bid-ask spreads are really just the difference between the asking and sales price of a stock. Now that we've set the stage for liquidity, let's dive deeper into the two main types of liquidity: accounting liquidity and market liquidity. And again, if you will, give this video a thumbs up for how many times I've said the hard word liquidity. Accounting liquidity is all about a company's ability to pay short-term debts with liquid assets. For example, a company with a cash reserve or a stockpile of liquid assets, such as stocks and bonds, is more liquid than one with real estate investments. Now, the other main type of liquidity is market liquidity, and it's about how easily an asset trades in its public market at stable and transparent prices. For instance, shares of a well-known company like Apple can be bought and sold easily, making them of a higher market liquidity, where shares of a small, obscure company might make it harder to trade, leading to lower market liquidity. So let's review. Accounting liquidity is all about a company's ability to pay short-term debts with liquid assets, and market liquidity is how easily an asset trades in its public market. Now, you may be curious about how to measure liquidity effectively and the impact of interest rates on liquidity. The answer depends on the specific assets under consideration. In brief, for accounting liquidity, there are several key ratios to examine, such as the current ratio, which compares current assets to current liabilities, the quick ratio, which excludes inventory from current assets, and the cash ratio, which only considers cash and cash equivalents. In contrast, when assessing market liquidity, you'll need to look at various metrics relevant to the asset in question. For stocks, for instance, you'd analyze factors like the bid-ask spread, which again is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept, and daily trading volumes. And then when it comes to something like real estate, you might focus on how quickly properties are selling in a specific location, as well as local market trends and conditions. Interest rates also play a significant role in liquidity as well. When interest rates rise, as they have been due to recent actions by the Federal Reserve, borrowing becomes more expensive, which can result in reduced liquidity in the markets. Higher interest rates may cause investors to move away from riskier assets to safer fixed income investments such as bonds, which can reduce the liquidity of certain assets like stocks. Additionally, in real estate, rising interest rates can lead to decreased demand for properties and longer selling times, affecting market liquidity. Hey, by the way, if you're enjoying this video, don't forget to smash that like button and subscribe to our channel for more financial awesomeness. Now, you might be asking, well, why should I care about liquidity? What's in it for me? Well, here's the thing. Understanding the liquidity of your assets is a key component to risk management and financial stability. When you can easily convert your assets into cash, you're better positioned to handle emergencies or unforeseen financial challenges. For example, having a mix of liquid assets such as cash and stocks can help you cover immediate expenses like car repairs or medical bills without having to sell off long-term investments or borrow money. On the other hand, if you're mostly holding illiquid assets like real estate or collectibles, you might struggle to get the funds you need in a market downturn or in a personal financial crisis. Imagine trying to sell a property quickly in a slow real estate market to cover an emergency expense. You might have to accept a lower price or wait for an extended period before actually finding a buyer. The same goes for collectibles or other illiquid investments that may be difficult to sell on short notice or at a fair market value. So caring about liquidity helps you build a more resilient financial strategy, ensuring that you have the right balance of liquid and illiquid assets to cover both short-term needs and long-term goals. This is why it's essential to consider liquidity when making investment decisions and managing your overall financial health. Moreover, liquidity can help you diversify your portfolio. Investing in assets of varying liquidity can help you spread your risk and maximize your earnings and build a stable portfolio over time. So there you have it, folks. That's pretty much the ins and outs of liquidity. I hope you enjoyed this video and found some information you feel like you can use towards achieving your financial goals. Thanks for watching, and we'll see you on the next video.